and thank you for remaining with us. You're still watching Financial Markets, and my name is Anthony, your host. And now we are going to cross over to the Nairobi Securities Exchange, but just before we do that, a humble reminder to register with OTEX East Africa under their initiative ZABU by dialing *292#. You do this with your MTN SIM card or MTN line, and you will be able to open an account. You'll be able to buy shares, you'll be able to buy securities,
ZABU allows
and
you to buy.
you'll be able to buy bonds and bills across East Africa, and that is in Kenya, Uganda, and Tanzania. And you will just need to open up this with, of course, your account, and then you get to access the bonds and the shares, and you can learn more about their products. You can buy your convenient product, either that East African bond, that Kenyan bond, that Ugandan bond that you're looking at being able to purchase. And when you do that, you receive a notification on your phone that the money has been received, and you possess the security. And if you want to trade or buy or sell, you do exactly the same thing. Of course, OTEX East Africa helping you there to do something new. And these particularly very interesting, when you look at these very interesting innovations that are coming up, young people are coming up with ways of making the stock markets, making the debt markets very accessible, from things that we think are for the rich people, from maybe things that we think belong to a specific category of people, to things that are everyday, because these are everyday products. These are things that people buy and sell, just like we buy and sell food in the market, just like we buy and sell clothes. So it shouldn't be something out of this world for you to be able to buy stocks, for you to be able to buy a bond, to be able to buy or sell a financial instrument in this category of the financial markets. The markets also include the commodities market. Yes, we have, for example, the developed markets already, like the United States. You can find prices of maybe gold or copper on these markets, and they basically give a chance to traders to be able to harmonize and find a common ground where they can sell at a common price. And of course, this is not a fixed price, but at least a common price within a specific range. And these products are usually precious metal like gold, silver, diamond, and so on, or things like crude oil, things like maize, if you look at crops, things like wheat and so on, a barrel of oil, and all these things are traded still in the financial markets under the commodities product. But on the show here, we mainly focus on the stock market, but as well, we look into the debt market, and this debt market, we look at the bills and the bonds, which OTEX East Africa there is helping you to access. On the other hand, for stock markets here in Uganda, you can dial *165# for MTN users as well. And by doing this, you will be able to access the MTN portal, where you can be able to fill in your details of your personal identification information, like your NIN number or passport number, and be able to open an account. The other way we rarely talk about, but we do talk about sometimes, is the unit trust. And this unit trust, or the collective investment scheme, is in a way a diversified product that comes as a result, of course, of collecting or putting money together. And that's why it's called a collective investment scheme. And these collective investment schemes are manned by fund managers. These fund managers include Zeno Investments, Sanlam Investments, you have Britam Asset Managers, you have Gen Afric Asset Managers. You have several people that are licensed, of course, only by the Capital Markets Authority to deal in this product. This specialized product came as a result, of course, of innovation, of course, and creativity of some minds that, of course, thought it wide money rather than small money. Think about it like this: if you are to buy a bond worth maybe 10 billion, and of course, maybe you don't have all the 10 billion, you only have 1 million. and that bond every single year returns a coupon. That coupon is the interest. That is the interest you're getting on a bond after lending to government. It returns a coupon at a coupon rate of 17%. That's about 170,000 every 6 months. Now, imagine if you invest your 1 million every 6 months, you're going to be able to get the coupon of 170,000. But then what the collective investment scheme innovators thought about was, let's have this money put now. When you come together, let's say you get a billion shillings is bigger than the 1 million shillings, definitely, and the return on a billion will be 17 million. Like this, so you have 10 billion, 17%, and you have returns. So actually it's 100 million. If you have 100 million, let's not go to 10 billion. You have 100 million. So if you have 100 million, your return is 17%, and you've collected all this money from people with 300,000, 100,000. You have people who have brought in their 1 million, their 5 million, and all these people have put together their money, and it has amounted to a total of 100 million. Now you're going to get all this money and invest it at once. Of course, they invest in different things, but now I'm just taking a treasury bond as a case or as an example for us. Now, when they invest this money in a bond that returns 17%, you're going to see that every 6 months, you have 17 million of interest. Now, that compared to your 170,000, which would come out of the 1 million that you have invested, it's way bigger. So this is how the investment schemes or the collective investment schemes out of the need for small investments to grow into bigger investments and create a bigger return. That is one straight advantage of the unit trust or the collective investment scheme. But the other thing that the investment schemes or the collective investment schemes are putting on the table is the liquidity. These investment schemes, since people are bringing in money from different directions and you have all this money that you're managing, at any one point in time, if any one of the investors wants to pull out and maybe use the money, you have the money to give them. And the settling time is between 2 to 3 days for most, at least, of the licensed asset managers or the licensed fund to attract people to start investing. And they deal not only with individuals, if you are wondering, actually, they deal also with people like schools, people like who have pension investment clubs and the like. If you would want to invest your money, the unit trust is offering you this opportunity, and they give you a chance to be able to invest across the board in several assets without you having to use your small money, get a small return. They give you this chance to put together money with other bigger investors or smaller investors like you, and they invest this money on your behalf wisely, because this is their full-time job to invest your money. So they do it wisely and take a very small return of your return as well for their sustainability. But all these are innovations that have really come up for us to be able to conveniently trade on the market. You'll find fund managers like Zeno, they do investments like across the board. They do investments, for example, into the East African markets, that is the regional markets, Dar es Salaam market, that is locally here in Uganda, and they invest in the bonds and so on, and all these, and in the money market. In the money market, we are looking at the short-term debt instruments, that is the treasury bills, and in the long-term debt instruments, we're looking at the bonds. And they do this to diversify your risk, to be able to give you a blend of investments and blend a little bit in your portfolio, so you can have several investments here and there. That was just a brief about the unit trusts, about the convenience that people are bringing onto the market, how people are making it easy for you and me to invest our savings and make a little return out of it. Let's look at the Nairobi Securities Exchange here. Nairobi Securities Exchange is, of course, the leading stock exchange in East Africa. Since 1964, it has been trading, and we can see here last Friday, a total of 47 listed equities participated in trading, ending with 24 gainers. Came at, of course, East African Cables, who came in the first place, and then we had 16 losers as well, who were led from the bottom by Trans-Century Limited company there. And you can see East African Cables gained by about 8.57%, and then with a share price of 1.14 Kenyan shillings closing there. It was followed by Home Africa at 5.88%, then TPS, East African Serena, at 5.59%, and Trans-Century, who came out with an end-of-day price. Of course, Trans-Century was on the losing side, a matter of fact, but Britam Holdings came out at a 5.56% gain as well. Trans-Century came out in the last place after an end-of-day depreciation of 6.67%. That, of course, we see that he was followed by, for example, Ever Ready East Africa, who also lost by 3.85%, and then Liberty Kenya Holdings at 3.11%, and Standard Bank Group at 3.1%. Equity Group Holdings recorded the highest volume of over 8.55 million shares that were traded, and he was followed by Safaricom, who traded about 1.84 million, and Kenya and Power Lighting Company, who traded about 1.01 million, and KenGen, who traded 400,000 shares in the Friday trading. At the end of the last weekday of trading on Friday, the Nairobi Securities Exchange had a total of 3.169 shares that were traded, and compared with the previous day, that was a Thursday, 28th of August, of July, the data shows a 12% improvement. There was a 12% improvement in volume, and the current market capitalization is 2.2 trillion Kenyan shillings there on the market. Regarding the performance of their indices, the benchmark index, that is the NSE market index, that is the all-share index, climbed by 0.57 points at a 0.41% gain in points to close at 141.05 points, representing a one-week gain of 3.28, a gain of 13.32%, but an overall year-to-date loss of 15.26%. And when we look at other indices like the NSE 20, they also gained by 1.17%. You look at the NSE 25, that is monitoring the top 25 companies, and of course, that is on the amongst the 65 listed equities. We see that he also gained by 0.88%. And when you look at FTSE, NSE 25, 15 and 25, they didn't have any movements there, with a 0% daily change on the Nairobi Securities Exchange. Nairobi, just a brief background, if you are interested in trading in Nairobi, you definitely have access to their markets through some stock brokers here. You can visit, for example, Crested Capital. You can visit also SBG Securities, Dyer and Blair, all these Old Mutual, UAP Old Mutual. They will help you be able to buy stock in Nairobi there. The point is here to trade where you're comfortable and trade where you understand the markets, because knowledge and understanding are quite important. And of course, also your advice from the stockbroker or from your financial advisor will also come in handy. But when you look at the NSE, Nairobi Securities Exchange, it is the leading stock in East Africa, of course, offering world-class trading facilities for both its local investors and the foreign investors. The BOAS is based in Nairobi, and as you can see, that is their all-share index, how it has been performing for the previous 6 or so months. And when you look back in January, we had points above 150. They crossed 150 down to 125 in the month of June. And then back from 125, they tried to cross into the 130s. And right now, we are seeing them at 120s, as you can see, between 125 and 150. The Nairobi Securities Exchange operates under the jurisdiction of the Capital Markets Authority of Kenya there. And you can say that this Capital Markets Authority of Kenya have done a wonderful job so far, trying to grow this market. And of course, with the various challenges surrounding the markets right now, they're still surviving. We are still seeing that they're trying to maintain their performance. As you can see, companies there trading, and of course, having over 47 listings participate in trading on just a single day. Even when you have 65, that is quite a good performance. Because also activity, even if markets are not doing well and prices are going down, or people are not buying, but so long as there is some activity on the market, it's a very promising thing. Because anytime, anywhere, the indices could go up. Anytime, anywhere, these could turn out to be very profitable markets, as we are seeing, for example, in the United States. I'll end there with the Nairobi Securities Exchange, and now let's cross over to some of our headlines, of course, that are making stories that are making headlines in the papers, and we see where the financial markets are lying. I will start, of course, with the Uganda's borrowing has quite moved, and of course, Uganda is revising its borrowing model in order to manage their debt. Now, Uganda is considering changes, the Ugandan government is considering changes to future borrowing in the light of the rising debt. And of course, this was, of course, with the Ministry of Finance officials saying that such a move is meant to manage debt and reduce the burden of payments. Maris Wanyera, who is the Director for Cash and Debt Policy at the Ministry of Finance, says that one way that will be used to re-examine ratios of interest payments to tax revenues, as well as interest payments against export earnings, in addition to the debt to economic growth balances. Future borrowing will be biased towards concessional loans and the domestic debt market for purposes of budget support, but they shall not acquire commercial loans for project implementations. Uganda's debt to GDP ratio, usually measured as the level of the indebtedness based on the national wealth, rose 4% in June from 49.1% by end of May, based on the cumulative debt statistics that were captured between July 2021 and June 2022. It means that Uganda owes about 73.5 trillion Ugandan shillings, that's 19.2 billion US dollars, with external debt valued in excess of 40 trillion, that's about 10.5 billion US dollars, and recent government data shows. Member states of the East African Community Bloc are required to maintain a maximum debt to GDP ratio of 50%, in line with the monetary Union convergence targets approved in 2013. It is a benchmark also adopted by the International Monetary Fund as well. The latest increment in the public debt also points to short-lived opportunities realized from previous economic rebasing exercises and an undertaking, of course, to revalue the size of an economy. And of course, growth benchmarks plus adjustments in key economic performance areas and indicators such as the GDP, the debt to GDP ratio, the tax to GDP ratios as well. Uganda's pioneer economic rebasing exercise was done in 2012 and was followed by another in 2019. And the results from the 2019 economic rebasing showed the value of Uganda's economy that it had grown to 137 trillion Ugandan shillings, or about 35.8 trillion billion US dollars, while its tax to GDP ratio had dropped from 13% to over 12%. The size of Uganda's economy grew from 1.48 trillion in financial year 2020-2021 to 162 trillion in the financial year 2021-2022. Findings from the two economic rebasing exercises yielded a debt to GDP ratio of 40 to 50%, which is a scenario that offered technocrats limited breathing space for future borrowing activity, thereby necessitating further review of borrowing plans. Latest economic data also shows that the headline inflation averaged less than 5% during the financial year 2021-2022, while economic growth stood at 4.6% during the same period. The country's savings to GDP ratio clocked 17% by close of 2021-2022 financial year, while the youth unemployment, a leading poverty indicator, was 13% in the same period. But economists say the debt accumulation thresholds are difficult to meet even in big economies. Of course, how much of public debt is put to productive use and what is its return on investment? Uganda's economy looks less bankable to credible lenders because the rate of debt accumulation exceeds the pace of development experienced in the country. A scenario, of course, given by Mr. Madina Gulova, who is a senior research fellow at the Economic Policy Research Center based at Makerere University. Analysts say debt portfolio is not a bad thing as long as the money is used well. Debt levels are growing up in various economies, yet no country is ready to stop borrowing at this time. What matters really is the motive behind the borrowing. For example, if government is borrowing to invest in maybe a new power dam, for example, let's just give an example of a new power dam, while another that has been under construction for long is yet to generate power. Of course, that will not be a very good thing to do. To start a new dam, yet you have another dam that has been under construction and has not yet produced power. So yes, the debt is there and we are trying to regulate it, but we cannot. We have to keep sustain the economy to be able to fund our to fund our economy, to be able to fund the government activities and so on. These will help actually grow the market. But as you can say, the government is trying to move away from more of these commercial loans, especially from foreign banks like Exim in China. You're looking at banks like the French banks that are borrowing huge amounts of money, that are lending huge amounts of money to many African countries, down to the concessional loans, especially those that are, with very low interests or that come with at least given longer periods of interest. And when we also come to the other side of domestic borrowing, government is saying it's trying to also enhance its domestic borrowing methods or models. And that is where our treasury bonds and bills come in here at this exact moment. If you don't know about this, it's already too late. You should have known about them tomorrow, yesterday, matter of fact. But these are instruments listed on the Uganda Securities Exchange. There are instruments all over the commercial banks in Uganda where you can go and lend government. And you lend government and government pays you back with an interest after a specific period. They're divided into the long-term instruments, the treasury bonds and the treasury bills, and also the short-term instruments. That is the treasury bills. Those are short-term. That is 3 months, 6 months, and a maximum of a year. And these give you a chance to be able to participate in the borrowing of government, and also you help reduce government's borrowing from abroad, but also you get a little bit of interest every after a specific period. For the bonds, every after 6 months, you expect something on your account from your coupons. You know, your coupons are coming in every once in a while, and you're gaining, you're gaining value on the market and so on. And these are what people are looking at as saving the government, at least from the huge amounts of debt it has from external borrowers. You can imagine 73 trillion. Our budget was about 48.1 trillion, and you have a debt of over 73.5 billion. Now that's almost twice the budget. So how are you ever going to be able to pay that amount of money, yet it's actually increasing in interest? Yeah. So to try and regulate this space, we are seeing that the government is doing its best in terms of these domestic borrowing and also getting concessional loans to help in financing its activities here and there. Of course, lastly, we talked about the United States stock markets that have, of course, turned out very well for this particular month. And of course, experts are saying this is the best month of the stock market in the United States since their inception. And we are seeing that since 2000, yes, not since inception. You're seeing that this is the best year, the best month in particular for the stock markets since the year 2000. And they are, of course, saying that they didn't expect this because there were many worries, there were many fears of the recession, there were many fears of people, of course, looking at businesses that were losing a lot of money. But despite all these, we are seeing that the stock market in the United States actually moved in the positive direction with various futures like the Dow Jones come out on top, and of course coming into the limelight there as they win over the other stock markets. And the stock market rally in focus, of course, after the best month since 2020. We're seeing that investors will look for the stock markets to maintain its recent momentum after the S&P 500 and the Dow Jones both had their best month since 2020 in July. And when you look at this, of course, it's affecting how things are done in the United States. And of course, when you look at the Dow Jones futures currently at 32,000 US dollars, 32,769 US dollars. You're looking at the S&P at 4,122 US dollars, while the Nasdaq securities, Nasdaq futures at 12,933.75. Really, these stock markets are quite promising. And experts say that August begins with investors looking to build on gains following the best month for the U.S. equity markets since late 2020s. In the week ahead, the July jobs report and a continued flood of corporate results will remain top of mind for investors. And Friday's employment data is expected to show non-farm payrolls that grew by 250,000 in July, while another 150 companies in the S&P 500 are set to report quarterly results in the coming week. Roughly 56% of the names in the index have unveiled the figures so far. United States stocks finished off their best month since 2020 on Friday, as markets rallied in each of the week's final 3 trading sessions. For the month of July, the S&P 500, which is one of the very main indices there in the United States, gained by 9.1%, fighting back from its worst start of the year since 1962, after the benchmark index plunged 20.6% in the first 6 months of 2020. The Nasdaq Composite rallied at 12.3% to reach, to notch one of the best months in, of course, on the record. And the Dow Jones Industrial Average rose by 6.7% of the month we are seeing here. And the sharp rebound of the equities in recent weeks comes amid expectations that slowing economic growth may prompt the Federal Reserve to scale back its interest rate hike, of course, hike cycle in that fall. And the last week, of course, the advanced estimate for second quarter GDP showed the economy contracted at an annualized rate of 0.9%, marking the second consecutive quarterly decline for the measure and meeting the unofficial definition of a recession. And of course, that gives us a picture of how good the markets are there in the United States. But of course, there are companies here that are helping also invest in foreign stocks, and we have not had so many though. But definitely we will be giving you more as it comes in. Thank you very much for remaining with us till this moment. My name is Anthony. I'll catch you tomorrow, same time, same place. Remember to follow me on social media as Anthony Sebale, and you can also follow Smart24 at Smart24 TV. See you tomorrow. Have a good day.